I'm Nayan Chanda, editor of Yale Global Online, and we have in our studio, returning to our studios, Martin Wolf, the chief economics writer for Financial Times. Martin, welcome back.
It's a pleasure to be here again.
And Martin, I'm very pleased to have in my hand your latest book, Fixing Global Finance. No other title could be more appropriate for these days. So it's very nice to have you, Martin, with us. I thought since we have you here, world's foremost expert on the financial issues, we might actually use this opportunity to have you give us a primer on the crisis that is roiling the world. To start with, first of all, how does one explain that American mortgage holders' failure to pay their mortgage could create such a havoc in the world, leading to banks failing, including a government like in Iceland toppled over because of that? So how do you explain that?
Well, it is in a way quite difficult to explain, and it is important to stress that I, at least, and there were others who did much better, did not foresee a catastrophe of this scale. And even now, there are immense debates among serious observers, economists and financial experts, on what precisely has caused such enormous havoc. I think we have some sense of what led up to it and some sense of how it worked, but there are some real uncertainties, which I'll come to in a moment. So let us first start with what led up to it. My view is somewhat developed from what was in the book, which was finished more than a year ago, is that there were really two principal underlying drivers, deep underlying forces. The first has been really quite long-term, 3 decades of expansion of the financial sector, and particularly growth of credit and debt, and of the balance sheet of the financial sector, its total assets, at a completely unprecedented rate. So if you take, for example, the balance sheet of the US financial sector, it's been growing on average about 6 times faster than US GDP since the early 80s. And that was actually accelerating in this last decade.
What happened? Why did this acceleration take place in financial
Well,
sector?
this is in fact related to the second thing. I think that most of this expansion was, at least up to the late 1990s, was because after the 70s, which had been a big era of inflation really wipes out debt. So in the early 80s, there was very little debt in the economy. We liberalized finance. There was a new environment of low inflation and stability. People borrowed more. And merely by the act of borrowing more, they create credit. That's how it works. The banking balance sheet expands. They find new credit-worthy borrowers. The only real constraint on expanding the balance sheet for the financial system is its solvency, its underlying perceived solvency. And it was perceived to be very solvent, so it expanded steadily. But I think in the late 1990s and early 2000s, something changed, and this is the second cause which I really focus on, the global imbalances issue, which is that for a number of reasons that are quite complicated, I probably don't have the time to go through right now, the emerging economies of the world, particularly in East Asia, emerged as vast surplus savings countries. They ran huge current account surpluses, which means they had an excess of savings, looking for a home. And first, that drove down real interest rates worldwide. They got very low. Secondly, the home turned out to be principally the US. The US emerged. It had been a small deficit country before then, but it emerged as a huge deficit country in this decade as the surpluses in China and other Asian countries, later the oil exporters, exploded. Now, if you started,
so this capital
came into the US. It was invested largely in foreign currency reserves, so very liquid assets, which were invested essentially in the US market. A lot of it went to buy the liabilities of Fannie Mae and Freddie Mac, as it happens, which were part of this. It provided an extraordinary liquidity base, which could be on lent. And it also provided an environment of very low real interest rates, which made it very attractive for people to create what I think of as pseudo high-yielding safe assets. Because of these background conditions, the very low real interest rates, the flood of money availability, there began to be a series of housing bubbles across much of the developed world, and there was a very big one here. In the context of a housing bubble, go back to my story about credit, well, house prices are rising all the time, so it seems completely safe. You borrow against a house, even if you don't have much money, it's quite safe because next year the house will be worth more. And then if you have difficulty in servicing the debt, you can always sell the house, so it's not a problem. In fact, it began to become obvious, not just in the US, the same happened in the UK, in Spain, that you couldn't lose money borrowing for a house. And then that led to the final stage, this sort of capstone of this combination of these housing bubbles linked to these two phenomena. They started creating all these very clever securitized assets, very complicated assets, bundling together mortgages, which seemed to provide safe, high-yielding assets, just what everybody wanted, and they started selling them all over the world. About half of the US assets related to this bubble ended up all over the world. Now, if you look now in retrospect, it seems to me pretty clear it's this combination of events, which by 2006, roughly, the peak of the housing bubble, had primed the situation for disaster. And the disaster, of course, happened when house prices started to fall, when everything basically unwound and they suddenly discovered they had all these bad assets.
So the whole sort of borrowing spree was based on the assumption that the house prices are always going to go up.
Indeed.
And when that gave away, the whole thing came tumbling down.
Yes. Well, the fact, of course, that there was simply so much credit. I mean, household debt in the US and the UK doubled over 10 years to levels that has never been seen before. So you have a hugely over-indebted household sector. You have a hugely expanded financial sector with very little equity because nobody thought it was needed because it was all safe. And a lot of it was pinned against these complicated securities based on the assumption that house prices could only rise. And lots of American economists, Bob Shiller here at Yale was an exception, but lots of American economists I spoke to said that it was impossible for house prices to fall across the country because they'd never fallen. It was a quite normal view. Sensible people thought this. Of course, it turned out they were utterly wrong. And then, of course, you suddenly get a vast quantity of impaired assets, and nobody knows how these new securities, which have very opaque structures, are actually going to work, what they're going to be worth once the underlying assumption about house prices, and therefore the ability to resell houses in difficulty, turned out to be wrong. We also discovered, of course, and we know that in a late bubble phase, completely normal, lending standards was lowered. That's not new. And as a result, a lot of people received houses, again, not just in the US, also in the UK, who really couldn't afford the loans. Once the house prices fell, they were insolvent.
So again, this bubble was also partly fueled by the savings of the East European Asian countries.
That is my view, yes, absolutely.
Putting their money in the US, buying treasuries, and resulting in lower interest rate.
This was what was Ben Bernanke described in a very famous speech he gave, I think about 5 years ago, the savings glut hypothesis of what was going on in the world. And my book explained, actually I was thinking about this before him, I wrote about it even earlier in the 2000s, and I had been very concerned about the effect of this savings glut for a long period. And the main reason I was so concerned, I didn't expect the complete collapse of the financial system, but was because if you looked at the US economy, it turned out that the counterpart of the excess savings in the rest of the world was excess borrowing, particularly by the household sector. The US household sector in the middle of this decade was running an unprecedented financial deficit, as was to say, it was spending more than its income by an unprecedentedly large amount and borrowing vast amounts both to finance that and to finance the assets they were purchasing whose prices were clearly in a bubble mode. This, I thought, was a great source of fragility. I stress that in my book as one of the sources of fragility associated with the imbalances, and it turned out to be correct.
And the other side of the same coin is the Chinese huge trade surplus.
That is correct.
When the US household is going into debt, what they're buying is often the products from China.
That is correct.
And so the Chinese became almost deliverer of seller's credit. They are giving money to the US so that the US can then go and splurge.
Yeah, that is correct.
And
vendor finance,
yeah,
you might call
right.
it. That was part of the mechanism. They bought US treasuries,
Right.
and the counterpart of that, they were financing in a way their own exports, a lot of which were going to the US.
Right. So now, explain to us, how did this housing bubble burst in the US spread so fast to the rest of the world? What's the mechanism?
Well, this is interesting, and it's where it's also become so disturbing. I think there were two aspects of this. First, as I've already mentioned, about half of the securitized obligations, the CDOs, collateralized debt obligations, and the CDO squareds, these very complicated obligations, have actually been sold abroad. A lot of them to European banks. The European banks were also looking for high-yielding, safe assets, and they ended up all over the world. Some European banks actually bought US subsidiaries which were actively engaged in household lending. The very big British-based bank HSBC is an example of a European bank that had bought a US mortgage lender, but others just bought all these securities. About half of them ended up abroad. So that was one reason why this became global almost at once. It became obvious that these assets were everywhere. Indeed, one of the worst hit banks in the world by this was UBS, the Swiss bank, which had a very active American subsidiary, which was deeply involved in this and ended up with an enormous exposure, which is why the Swiss government has had to rescue it. But that's only one thing. The second thing that you have to remember, and this is a point I stress quite frequently recently, is that the financial system of the world in the last 10, 15 years did truly become global. The big players of the world, the big financial institutions, particularly of the West, all operate globally. They all have American subsidiaries and European subsidiaries, and they're all interconnected, very closely interconnected.
So total globalization of the financial system.
So the globalization of the financial system was extreme. So once any significant institution gets into trouble, and the most famous such case, of course, is Lehman, the third largest of the investment banks in the world, got into trouble. Well, Lehman is a global firm. It does business, or did business all over the world, and it did business with everybody. It did business with any major banking institution you can imagine, and with hedge funds everywhere. So, of course, once Lehman, to take this very salient and important example, went under in middle of September of last year, it affected the confidence in counterparties everywhere, because everybody was dealing with everybody else. So there was no longer a national financial system. The US didn't have a national financial system, neither did the British, or indeed very much not. Well over half of the assets of our banking system are foreign assets and liability. You talked about Iceland. Well, Iceland was an extreme example of that. Iceland is a tiny country with a few 100,000 people. So nearly all the assets and liabilities of the Icelandic banking system, which exploded in size to almost 10 times GDP, its assets and liabilities, nearly all of these were abroad. They were part of the global system. The Icelandic people couldn't rescue this. Once the assets went down, these institutions were insolvent and no government could save them. So one of the things we've learnt, in fact, is that a significant crisis affecting an important class of assets, like housing related securities, immediately becomes global, because all the institutions have invested in them and all the institutions are dealing with all the others. So I don't think you can possibly imagine anymore a national financial crisis. It's one of the most important lessons of the whole mess. There's one final thing, of course. Once the financial system is impaired, it doesn't lend anymore. It's too frightened to lend to anybody, and that was particularly severe in September and thereafter. Of course, it affects the rest of the economy. Nobody can borrow. Business can't borrow. Governments can't borrow. Corporations, even the safest corporations can't borrow. So you then have a crisis in credit, which affects, in fact, the entire world. The emerging economies are affected, consumers are affected, so they don't spend, and that's of course why in the last few months we moved into a global recession, which some people think of as a depression, simply because recently the decline in GDP for some countries, have been so very, very severe. I mean, Japan, for example, has the last quarter, as I understand it, has had a negative growth at an annualized rate of 10%. Mm-hmm. And similar things are being seen in other East Asian countries. In fact, they're particularly badly hit. China's growth in the last quarter was probably zero, which for China is a depression, right? Mm-hmm. So it's certainly worse than a conventional recession. And unless it turns around fairly soon, it's going to feel worse than anything since the 30s. And I think this is how we got here. It's a global system which was built on global causes, but very, very large regulatory and other mistakes in various countries, and particularly the US.
So one of the basic disequilibrium that he mentioned is the high savings in China and high indebtedness in the United States. This disequilibrium, how can one resolve that, or at least narrow the gap in the current situation? You wrote, I think yesterday or last week, that the Chinese growth should be 10% a year and China's domestic expenditure should be 12% in order for this gap to be narrowed. Is this realistic?
Well, I think this is a huge question now because it comes to the issue, how do we get out of this? I mean, this is very scary where we are now. This is a very severe global recession, and we want to get out of it as quickly as possible. So how do we do that? Well, we all recognize, though we're not doing a very good job, that we have to fix the financial system. We have to recapitalize it or make it sound in some way. Governments are struggling with that. I would say no one has been fully successful yet, including, unfortunately, the United States. But nobody has. But that's one thing we have to do. We're going to have to help hugely over-indebted households because there are lots of bankrupt people, and we're going to have to fix that. But there's also this very big issue, as you rightly say, about the demand expansion in the world in the future. Now, if we think about it, if we assume there's no change in the surplus countries, assume we continue with the sort of world we've had before. Well, you think about the US, a point I've made in previous columns. The UK is essentially the same. You've got a large current account deficit because the structure of your economy, after many years of specialization, you don't have production of much tradable goods in particular. So once you get to full employment, you tend to have a very large current account deficit. There's excess demand. So the question you have to ask yourself, what could generate excess demand in the United States on that scale again? Well, it's not going to be the household sector, which is very badly indebted and needs to save more. It's very unlikely to be the corporate sector in this situation. So what's going to happen, and it's clear what's going to happen, is the US is going to run to sustain demand enormous fiscal deficits, 10%, perhaps even 12% of GDP, unimaginable numbers. Now, for a short period of time, of course, the US can run fiscal deficits of that scale, but it's very risky. You're going to pile up enormous amounts of fiscal debt. So to stop this from going on, either there has to be a huge pickup in domestic demand in the US, going back to the bubbles. I don't see how you can do that easily. This was, I think, the last big private sector bubbles. Or the US external balance has to improve. Now, it's a matter of definition. If the US and UK and all these other countries are going to have better external balances, more demand, somebody else, if we have dynamic growth in the world, we don't want to compete in depression. That will be, beggar my neighbor policy, that used to be called. You want expanded demand in the rest of the world. Well, who are in the best position to expand demand? Obviously, countries with very strong balance of payments positions, with very strong current account surpluses and reserves. Countries like Germany or Japan or China. If they don't expand demand relative to supply, I think we have the danger that we sort of chronic excess capacity in the world, chronic deflationary pressure. If you like, the whole world starts looking like Japan in the 1990s. That's sort of my worry. Even with printing all the money, that is sort of my worry of what might happen. And the Japanese have printed money like mad, and they've still remained like this. So we do have to expand demand. Now, understand completely, if you take the case of China, which is simply the most important single country, that they can't change their structure of their economy, the structure of demand, overnight, except through a massive fiscal boost, which is what they're now doing. They are actually engaged in a huge investment program, and in the short run, that's the right thing to do. In the long run, however, I think it is right for the Chinese to try to absorb more of their production at home and rebalance their economy with more service production, which would generate also much more jobs. They have not done a good job of generating jobs recently because the development path has been quite capital intensive, much too much dependent on investment. And household disposable income is only 40% of GDP, which is why they're not benefiting fully. So what I suggested in the piece you mentioned, which I produced as a blog during the World Economic Forum in Davos, is China should forget having a GDP target. Instead of having its sort of 8% of growth GDP target, it should have a real domestic demand target. It should think of its policy in terms of generating real domestic demand. GDP will follow. Yeah. And I suggested if you said they should try and grow real domestic demand at 12% a year for 5 years, that will solve the problem. It would help the world, and it would make the Chinese themselves better off. Now, I recognize this is a huge challenge, but the first step to meeting the challenge is to define the problem. And I think that's the right way to define the problem. I think there are similar difficulties in Japan. They have allowed domestic demand to languish now for 19 years, since 1919. They've got to fix that. Germany has a similar problem. There are a number of other smaller countries. If this problem is not fixed, I don't really see how we get out of this, at least in the near term, without these monstrous fiscal deficits in the US and UK and a number of other developed countries as the source of demand. And that's going to be politically very difficult and ultimately, I think, unsustainable. So the thing that worries me most is not the clearing up of the financial mess, though that's a big issue, or even the clearing up of the over-indebtedness of the household. The thing that worries me most is, as it were, where is the demand going to come from to sustain rapid growth in the world economy in the next 10 years or so? And for that to happen, I don't think we can repeat a pattern in which we've been so dependent on excess demand from the households of a limited number of rich countries.
Especially, I think what is one has seen in the United States, that the tax credit as a stimulus for spending, it didn't work. People are hanging on to their money because they want to retire their debt rather than go and splurge in the shopping mall.
Absolutely.
But the same thing is happening though in China. I gather some city governments are giving out coupons,
right,
to consumer coupons, and people are trying to turn that into cash and hanging on to that.
I'm sure that's true.
So
risk aversion.
Yeah, so people are afraid to go to the shopping mall.
That is right.
That's one thing. And second thing, of course, is that there's so many dead banks still walking. So how do you retire those banks and actually create a possibility of people getting credit from the banks at a reasonable rate?
Now, my view on the first of these questions, I don't think the fact that people are saving a lot is so bad, because people do have to reduce their debt. I mean, it's quite reasonable, and if we help them to do that without inflation, that's not a bad thing. But there's no doubt in my mind, and this I know has been a huge, almost religious debate here in the United States, that in the short run, in these conditions, it makes most sense to expand the forms of spending by the government which are immediate. So, and some of which goes to people. I mean, unemployment compensation, of course, you're going to need a lot more of that to sustain people demand. In this country, giving money directly to state and local governments so they can continue to employ teachers and firefighters and all the rest of it. So there are things that you can do which will sustain spending, and if necessary in present circumstances, the government can simply borrow from the central bank, there's no problem about inflation, to support this form of spending. So in the short run, that's, I think, what you want to do. If you provide tax cuts in the present conditions, I would expect most of it to be saved. I mean, that seems to me inevitable. That wouldn't be the worst thing. The way I put it, it just means if that's what's going to happen, the stimulus bill, the total deficit, has to be even bigger, because you want to offset the fact that so much of it is going to be saved. That is, I think, an inevitable part of this story. Now,
on the banks.
On the banks. This is a very controversial issue too. And I've written about this very recently. Very recently. You have to start, I think, with the first thing is to try and work out what's the problem. What is really the problem? And the truth is, we are still disagreeing on this. There are some people, quite a lot of people, who would say that the very low prices of the assets the banks are holding, which is what's driving their insolvency, largely just result of panic. If people understood the true underlying value of these assets, they wouldn't be so cautious, they wouldn't be so frightened. The prices of these assets would rise and the banks would appear quite solvent. And those people are the people who suggest that the real job is to find some way of being able to market these toxic assets again. Mr. Geithner's plan is very much directed at that, though how it would work is quite obscure. There are other people, and I'm one of them, who say, assume the worst. It's very likely the banks are insolvent because these assets are just bad. And certainly other people, the investors, think they're insolvent. So they think that they have to be recapitalized. There has to be a recapitalization program. It's very, very difficult to persuade the private sector to recapitalize institutions when they have no idea what they're worth. And because they have no idea what their assets are worth, but all the experience so far has been very, very bad. So unless you can find a real price for these assets, pretty soon it's going to be very difficult to get the private sector to recapitalize. And we're talking hundreds of billions, possibly even $1 trillion or more, so enormous sums. So that means that there are essentially only two other ways of dealing with this. One is both involve a sort of bankruptcy process, but the bankruptcy process can be done either by injecting government capital, you nationalize them, you take out the bad assets and put them in a bad bank, you nationalize, you put in public capital, and you refloat the institutions. This is very much what the Swedes did in the early 1990s. There is a variant of that in which you take you leave the bad assets in the old bank, it sort of dies, and you create a good bank with the good assets, so a new institution. There's a sort of question of whether you move assets into a good bank or move assets into a bad bank. That's a sort of secondary question. It's quite interesting, but it's a secondary question. The alternative way of recapitalizing them is an absolutely standard bankruptcy process, but here for a lot of institutions simultaneously, and that would essentially, you put them into bankruptcy, you would eliminate the shareholders' equity because it's worthless, and you would transform some portion of the bonds held against the banks into equity. So the bondholders end up owning the bank. That's a very common bankruptcy process. And then again, you would have a recapitalized bank and it will be off and free. Those are, it seems to me, essentially the alternative. At the moment, nobody around the world has been prepared to do either of these things on a suitable scale because it seems to me nobody has been prepared to recognize how big the losses actually are.
And also the old shibboleth about nationalization
Yes.
is still so strong that you cannot use that word and
correct.
hope to be reelected.
But what is so strange is people, well, they're not very happy, but people are prepared to accept large public subsidies to private institutions, or I would call some of them even bribes to private institutions, which have been misused and in some cases I would say abused, but they are very unwilling to actually just say, well, we own it because we are providing the risk capital. The reality, though, is that at the moment, the taxpayer is bearing the risk. I mean, it's clear. So whatever you call it, the risk capital is provided by the taxpayer. My view is if the taxpayer provides the risk capital, the taxpayer or the taxpayer's representatives has to exercise managerial control. Otherwise, you will know that the private sector will exploit this, as indeed they clearly did in the last quarter of last year, when you look at these grotesque bonuses which were earned in loss-making institutions using basically government money. Now, the crucial thing to say, this isn't nationalization in the long run. We're not going to have nationalized banks. It's just a nationally imposed debt restructuring. That's all it is. Yeah. The aim is to provide
It's a
private
short
money.
term.
It's a short term. Now, if you're really concerned about this, and it's difficult to refloat the institutions back into the capital markets quickly, I made a suggestion which I see was picked up this morning by Nick Kristof in the New York Times, which is just give the shares to all the American people if you want, and then it's not nationalized. The aim is definitely not to have nationalized banking system. I share fully the view that that will be a terrible thing. The question is, how do you restructure as bad banks? All the experience we've had of banking crises around the world, which I do discuss in this book, and there have been more than 100 really big banking crises in the last 30 years, though this is, of course, much the biggest, it's a global one, is you mustn't leave zombie banks in existing. Zombie banks kill the economy. Either they take unreasonable risk, or worse, they don't dispose of their assets and come clean with their balance sheets, and they don't expand credit. They don't do anything with their money. The zombie banks and the assets they have to be liberated. And that's an essential policy task.
Okay. The last question. About 4 years ago when you came to our studios, I think we discussed your book, Why Globalization Works. So now it looks like it didn't work. So what went wrong?
Well, the only thing I can say in my favor is the chapter on finance, which I've much developed in this book, was the most skeptical of all the chapters. It was the one which said, I said it very clearly in that book, finance is something that has clearly gone wrong. We've had a lot of financial crises. We have to learn from this some of the lessons. And I also discussed the possibility of very briefly of a major global crisis. Now, I have to admit that at that time, I wrote this book in 2002 and 2003, I did not, and it's probably a lack of imagination, foresee a bubble on this scale leading essentially to the demolition, or at least an immense crisis of a type I haven't seen in my lifetime, so since the Second World War, affecting the core financial systems of the world. And I'd assume that these would continue to be predominantly emerging market financial crises, and I focus, as I do here, very much on what you do with emerging market financial crises. Now, of course, it has become something global. And that I thought then it was more likely that we'd be threatened by some geopolitical or military event. We were concerned about terrorism, nuclear terrorism, that war. That was something I discussed at great length as a risk, though I did actually talk about a financial danger. Now, what we've learned is that the financial system is even more unstable, more dangerous, more fragile than I thought on the global level. I don't think it undermines the case for globalization in trade and foreign direct investment, and for the big, huge gains that have been made by countries like China and India, containing billions of people as a result of globalization. It seems to be quite clear the gains are huge, and if we look now at the deglobalization, it's all very frightening, and it could go really wrong. We could have terrible protectionism, and hundreds of millions of people, I think, will lose hope for the future. I think it will be a tragedy if that happened. But all that shows is that my concern about the financial system should have been even stronger than it was. That's why I wrote this book. And that the issue now of, one, reconstructing the global financial system so that it works better, so we don't have a crisis like this again soon, and I discuss that in this book, and I have more ideas since then, and that we deal with this big domestic demand balance problem, the problems of capital flowing uphill, which I have been concerned about now for many years. These are really even more important. Right. Now, policymakers, the big policymakers of the world, President Obama and the others, in developing countries too, that's why the G20 has become so important. Countries like India and China are also involved. We have to construct together a system that works better in this respect. It's an incredible priority. If we do that, I think we can keep globalization going. But if not, we may revert to the most terrible disasters which we saw in the 30s.
Like buy American or British job for British workers.
And it could get much worse than that. That's just pretty mild, but it could get much worse if a year from now or 2 years from now the world economy is still sinking and unemployment is over 10%, and in China, the economy is very weak, and the unemployment is very weak everywhere. governments will become populist, and populist governments will become nationalist, and we could have terrible global conflicts. So this is very, very dangerous, and we have to deal with it now. That's why I've been, I feel that by my standards in my writing, I've been almost hysterical, and I try to be very reasonable and calm in what I write. I think one should be. But I do think the situation we are now, we have been in since last September, is a critical situation in all the respects we've talked about. Policymakers have to deal with it. If they deal with it quickly and urgently and cooperatively, very important, it's a global problem, we need global solutions, then I think we can get through this over the next few years. And if not, we'll be in a different world, but it won't be a better one.
On that note, Martin Roloff, thank you very much.
It's a pleasure.
Thank you.